What's going on, guys? Anthony here from Market Chart Watch. Today we're going to be talking about retirement accounts and how we're going to make our children rich. Now, there's many different ways to do this, including a 529 plan. You can do something like a custodial account. But what I'm going to teach you about is something that's even better than that, which is just having an individual brokerage account. And how I'm going to show you all this is by looking at different asset classes, different amortization tables. We're going to be looking at compound annual growth rates over a 40-year period and from 1928 to 2024. So we're going to look at even like a 75-year period. I'm going to show you the returns from 1 year to 40 years on all of these things. And then I'm going to read you a pro and con list of which you should look at. So stay tuned. This is a great video if you have kids and you want to learn how to retire them with as much money as humanly possible with as little tax as possible. So number one, we have the most common investment point of use for most parents, which is a 529 education savings plan. So I'm just showing you one here from Schwab, but you can get one from Vanguard, Fidelity, wherever. In every state that you live in, it's going to differ on which 529 plan will be best for you. So in California, where I live, having a 529 plan actually doesn't give you any cost basis savings, and it's not the account doesn't provide you any taxable advantages. So what you can look at with these is with the 529 plan, the money you're going to be put in, you're going to have some limitations on what you can use it for. And so although a lot of people do use these, I don't consider them the best move for you. And we will get to that here later in the video. Another thing that you can do is you can have a custodial account. So this differs a little bit from the 529 plan in that this custodial account and the money that's in it will then be released to the child at a certain age. And you don't really have, a say in when that happens. So in the event that your child is going through some bad times or, just for education purposes, let's say your child is trying to get off fentanyl or heroin or has a drinking problem or gambles, you probably don't want your kid to come into contact with $1 million, right? And so you don't want them to lose that money. So this can be problematic, owning a custodial account, because the child at the age that they reach maturity or majority will then have access to those funds, and there's not much you can do about it. And so another option would be that you just open a traditional brokerage account, right? So that's the same brokerage account that you and me probably have for ourselves outside of our 401k, Roth IRA, traditional IRA, etc. And so we're going to actually talk about opening a brokerage account, and we're going to talk about what type of asset classes we should own if we are going to be putting money away for our little ones, because their time horizon is like 50 to 60 years, right? We're opening this when they are still sucking on their thumbs, relying on mom and dad to live. So we have a minimum of a 50 to 60 year time horizon of investment and another 30 years, 20 to 30 years of retirement. So this could potentially be an 80-year period of investment gains for this child if we start this early enough. And so what I want to show you with this asset class table, I'm going to pull this up from the Paul Merriman Institute of Financials. It's through the Sound Investing Portfolios. And they have a company called M1 Finance, and they put together all these comparison tables showing you all the different asset classes that you can add money into. And so one of the common things you would put money into is large cap blend, which is going to be your S&P 500 index funds. You're going to let that go for 30, 40 years, and that will give your kid a pretty good retirement. But what this chart will show you is the percentage of time those asset classes performed the best. And what I want to show you is down here you'll see a couple of 5 to 6% of the time these classes perform the best, and 8% of the time here, and 5% of the time here. And so what we really want to look at here is the outliers. And so you can see 53.7% of the time, small cap value performed the best over the average of 1 to 40 years. Okay, so the 40-year return rate, again, this is for our children, so this is where we're going to be living here, is on average a 53.7% time this class performed the best. And so you add, that large cap blend of the S&P 500 in there, and you did pretty well. Other categories that did okay were emerging markets, which I'm not going to really talk about here, and small cap growth. What I do want to bring up, however, is if you look at large cap growth, a lot of people love large cap growth. That's your big stocks like your Facebooks, your Amazons, all your growth stocks, Nvidia, didn't actually outperform the market. Okay, it underperformed. So large cap growth underperformed. Now, if we look at the time that those asset classes did the worst, you can see that small cap value did the worst 2 to 3% of the time, which is very low considering looking at all the rest here. And if we look at large cap growth, it did bad a lot of the time. And so just keeping in mind that a lot of people want to put money in growth stocks, and growth stocks are great when they're growing, but most of the time they're not growing. And so that's why those portfolios are very volatile, very risky, and that's why we really want to stick to the value side and the blend side of the indices. And we're going to talk about those quite a bit. You'll see in this video we'll spend a lot of time in small cap value and a lot of time in large cap blend for this very specific reason. Okay? So those are things I wanted to show you. These two categories, S&P 500 index, this large cap blend, and small cap value, did really well over a long-term period and did not do bad over a long-term period when things were bleeding. Okay? So another table that I want to show you just briefly before we get into the percentages here is what a 0.5% difference means over that 40-year period. Okay, so don't worry about the end of retirement age here and all of this stuff. All I want you to see is that we've accumulated 40 years worth of investments, and your child retired with 30 years. So overall, their money was in the market for approximately 70 years. Okay, we can consider that an average lifespan. And if we look at scenario 1, over that total lifespan, we got about $5.4 million. Okay, off of this base accumulation rate of return, which, by the way, is very low. This is not the average, 5.4 million. But if we got just a 0.5% better return on investment over those first 40 years and the retirement years, just a 0.5% better, we averaged $1.5 million more money. And so what this chart is telling you without looking at any of the numbers is that any increase in your what we call the CAGR, the compounding annual growth rate, any CAGR amount of 0.5% over that 70-year period is going to be worth $1.5 million. And just to clarify, over this 0.5% over about 30 years is going to equal about $500,000, so $500,000. So I want you to keep that in mind for the next chart. So when we look at the two asset classes that we want to fund our child's portfolio with, which I talked about here, which was small cap value and large cap growth, we actually have those funds here. That this US 2 fund portfolio is actually made up of 50% large cap blend or S&P 500 index fund and small cap value. Now, if we just invested in small cap or in the S&P 500 large cap blend, and that was $10,000 grown over 55 years, we'd have $3 million. But if we instead took that 10 grand and it grew over 55 years, it'd be worth double that. It'd be worth $6.5 million. So as you can see, that is because of this CAGR, this compound annual growth rate. 0.5% equaled 500,000 to $1.5 million. 0.5%. And if we look at that compound annual growth rate over a shorter time period, you can see that this 2 fund portfolio did 12.5%, and the S&P 500 only did 10.9%. So that is a difference of just shy of 2%. Remember what I said, 0.5% can equal about this. and we did 2% difference. So that's like $3.5 million of difference in that retirement, as you can see here. So I hope this is starting to click in your head why it's so important that you need to decide which sort of funds to put your money in for your child and how early to do it. So you want to start from day one, obviously, and we have to decide, are we doing a 529 plan, custodial account, or brokerage account? And when you have assets like this with, this kind of money, do you really want all of that in an education plan? Are we going to spend that much money on education? No. Do we want to release that sort of money to a child when they're 18 years old and they might be hooked on drugs or traveling the world or spending it on the girlfriend or boyfriend? No, in my eyes. But do we want to put it in a brokerage account that we can control and then transfer into their name at a later date? I would say yes, and I will show you why with a chart later on. So now what have we seen? We have seen that yes, our 2-fund portfolio of small cap value and large cap blend performed very well. Now, there are other categories that performed a little bit better, but they involved a bit more risk allocation and risk tolerance. What I do want to show you is the number of years that these funds were up. And you can see that for the amount of money we are making, right, for the amount of compound annual growth rate we are accruing, we are not accruing any more definable risk. So if you look, we're going to look at the risk here. The number of down years for an S&P fund was 11 over, a 40-year period or so. And the number of down years for our 2 fund was 12. It was one more year. The average down was actually less with our 2 fund because we're more diversified. And the sum of those losses was also less, to the tune of about 10 or so percent. And the worst year ever recorded was also less marginally. So what I'm trying to show you is this 2-fund portfolio that provided way more return on investment over the compound annual growth rate of gaining 2%. Traditionally, this would come with a premium of more volatility, but what this shows you is it was actually not as volatile, because in the down years, it actually did better than the S&P 500 index, which is your basic standard to test anything against. Okay, and with our up years, it's about the same for small cap value and for our S&P fund, but you can see that the average return on investment was better anytime the market was up in our 2-fund portfolio. Okay, and so what does all that mean? This basically means that owning small cap value and owning the S&P 500 index at a 50% weight of each, your return has roughly doubled based on this chart, growing for 40 to 55 years without incurring any noticeable change in volatility or inherent risk. And in fact, you're paying a lower premium to inherit less risk. Okay, so that's what this table is showing you. Now, we're going to look at another form of that table, which breaks it down by year. I'm not going to spend a lot of time here. All I want to show you is that the compound annual growth rate for the S&P 500 was 10.9%, and the compound annual growth rate for our 2-fund portfolio, which includes S&P 500 and small cap value, was about 1.5 to 2% better off of this just short 40-year period. Okay, and so your child would not even be retiring by the age of 40. They still have another 25 years of working to let this money compound at a higher compound annual growth rate. So you can see how this is going to snowball and snowball and snowball. Now let's take these returns and really extend them out. We're going to go from 1928 to 2022, and we are first just looking at the S&P 500 index. And what I want to show you is the rate at which you can remain net neutral and then expect to make a profit is at 15 years. So what does that mean? That means that historically, irregardless of what period you've ever invested your money, by year 15, at any point in history, you are able to clear a positive gain, okay, or a compound annual growth rate that exceeded any losses. So if you happen to start investing in the longest bear market in history, after 15 years, you made money. That's just off the S&P index. And you can see here, based on these numbers, that's going to equate out to about 10.9% if you were to add all these up and then divide by the number of years, okay? And so you can see after 40 years, the average was 10.9 to 11%. Now, if we took that same chart and we did it for our 2-fund portfolio, which I say is the best thing we can do for our child, you can see that we assumed no greater risk, but we did assume greater returns. If we look, we still, even if we invested in the worst time in possibly in history since 1928, it would have taken 15 years for us to get a compound annual growth rate that made us a profit. And after that 40 years, that profit is around 13.9%. So that's huge. Compound annual growth rate compared to 10.9 to 11%. So now you're looking at a 3% difference. Remember, every 0.5% can be $500,000 to $1.5 million, depending on the time period. So this is incredible. We have no greater risk. You can see if I go back one chart, it's the same thing. It takes about 15 years if you invested in the worst time in history, and it's the same for small cap value and the S&P 500. So you'd be silly not to add greater returns with less risk. Now, if we look at just going full risk and going full small cap value, we do notice that it took, if you invested in the worst time in history, it took you 20 years to get a compound annual growth rate that got you out of all of those bad years. But your kid is still 20 years old by that point, so it doesn't matter. You probably aren't even releasing the money to them anyways at this point. And around year 40, you have about a 16.2% return. This is really out there because now you're all in small cap value. You're not very diversified. And this portfolio does actually inherit a bit more risk. So you can see it took 5 extra years on top of this to make that return favorable to you. And so what does that really all mean in the term of this? Well, I'm going to break down a chart for you that talks about all this. We just talked about a regular brokerage account, a custodial account, and a 529 plan. Don't mind this smart gifting strategy. But this regular brokerage account will really benefit you because you are able to just invest 50% of that money in small cap value and the S&P 500 index fund of your choice, and you have full control over that investment. There's no restrictions on how you use that money. So unlike a 529 plan where you have to use it on school or other things, and because it's a brokerage account, there is no early withdrawal penalties. Now, one of the cons of this is you need to be mindful of the gift tax limits if you're transferring this to a child later in life. But if this child turns to an adult at the age of 18 and you want to transfer this account to them, you can actually do this without incurring any taxable fees. All you have to do is submit a tax form that says you are gifting this. But because the money is staying in the account and the money is not, you're not selling the assets, you're not incurring any taxable events. So you're not going to actually accrue any taxes from this. It's just a form you have to file with the IRS, if that makes sense. Now, with your custodial accounts, the money is for the child. There's lower initial tax rates on unearned income, although this is not true for California, so this doesn't apply here. And then this child gets full control of the money between ages 18 or 21, so this could actually be terrible for you if this child gets this money at the wrong time in their life. 529 plan, tax-free growth for education. Again, a lot of this stuff the states don't offer tax deductions for this, so it's not actually super beneficial in states like California. And then this money has to be used for education or some form of it, and there's limited things you can put your money in, so you can't just choose small cap value in these funds. Also, the problem is that if you do withdraw this money for anything outside of education, for both of these, you will incur a pretty hefty tax. It's like 10 or 15%. And then smart gifting, we won't have to worry about this because you're not selling the asset. You're going to be transferring accounts to them, so it works a bit differently than this. So, in a nutshell, what I really want to just kind of bring home to you is if you are investing for your little ones and you don't know what the world is going to hold in the next 40 to 60 years, will there even be colleges around? Is Google just going to offer degrees for anything? Like, we don't know what the future holds. I would strongly consider just opening a brokerage account instead of a custodial account or instead of a 529. Why? Because I myself have the ability to choose what money or what funds I want to put my money into to capitalize as much as possible based on historic returns. And so by doing so, my returns I could basically double them from the S&P 500, and I can probably do much better than whatever, a 529 education plan will have in its portfolio. It's going to be some form of a target date fund, which over a long period of time returns about 8.5% with high fees. So ultimately, I think the best option for anyone who's financially savvy is get in control of your children's assets. That way you are able to choose where their money goes. You are able to decide where you can put that money to get the best compound annual growth rate. And then you can then have full control of that investment. You'll have no restrictions on when to use that money, and you get to decide when it gets transferred to them. Anyways, this has been another video from Anthony here at Market Chart Watch. Thanks for watching. Like, share, and subscribe, and we'll see you in the next video.